Any advice and information from this podcast is general only. It has been prepared without taking into account your individual circumstances and needs. Before acting on any advice from this podcast, you should assess and seek advice on whether it is appropriate for your needs, financial situation, and investment objectives. Welcome back, ladies and gentlemen, to Not Another Finance Podcast, episode 473. Cut. No, what is it? Action.
Action.
Yep.
That's it. Yeah.
All right. One of J-Mac's favourites, something that's come up with a lot of her clients and a few of mine.
Debt recycling.
All right. What is this? Does that mean I'm grabbing my home loan and putting it in the recycle bin to get my 10 cents back? Ooh, it's similar-ish.
To get your 10 cents back.
Yeah, there you go.
I like that
You're
one.
welcome.
Yep.
I just saw the word recycling. But give us a little bit more. What are we talking about, J-Mac? What is this?
So, sorry, I was just checking our microphones.
Yep.
Debt recycling. I feel like it's making money out of nothing, really.
What? Okay, from your home loan?
Yeah.
All right.
Because
okay.
what if your home loan wasn't just something you kind of paid off, but actually something that kind of helped you build wealth?
Is your home loan the house you live in and the loan you pay?
Mm-hmm.
Would you call it good debt or bad debt, and why?
My home loan?
Yep.
It is half good debt, half bad debt. And
Cool.
It's half good debt, as in half of the house I live in is tax deductible for any interest paid.
What the hell? How do you make tax deductible?
Because I guess you always hear about investment properties and how they're...
Yep, but this is not an investment property, is it? This is
No.
So the house you live in, which is non-investment property, you and your partner live there,
Mm-hmm.
but you're turning it into a tax deduction.
Yeah. Take that, ATO.
Shit. So is that sort of touching on generally good debt is tax deductible debt,
Mm-hmm.
bad debt is not tax deductible. There's no fruits from it really,
I guess
is there?
so, yeah.
Cool. So when you kind of, to draw a picture maybe for some people, visualize, we might throw something up on this. Oh, our new
wall.
facade. So bad debt. Let's see. Buy a U-Butte car,
Mm-hmm.
not for work. It's just a flash ass car, 50 grand, loan repayment. Kind of bad debt. It's not really going to make you any money. You're not renting it out or anything.
Yeah.
ATO gives you no kickbacks.
Yes.
Good debt, as I guess if we use the car analogy, car for work, you can claim depreciation, fuel, maintenance,
Mm-hmm.
interest costs for the business, that kind of stuff. So when we talk about a house you live in,
Mm-hmm.
which isn't really producing income,
Mm-hmm.
because you can't charge anyone rent, so all that it's doing is hopefully going up in value in the background while you live there.
Yeah. But usually with just a normal house that you buy and live in, it's not tax deductible.
Not really, no. That's kind of on the bad debt.
Might be bad debt.
Would you even call that an asset? I suppose you would, depending on how you, yeah?
Yeah.
So a good debt you're saying is you can use that home loan and convert it into a tax deductible portion. All right, tell me more.
And no one knows about it, and it's the best thing ever.
They don't openly advertise it on the ATO, do they?
No.
Or through, and we only found out about it through one of our Freemason Deep Society forums, didn't we? No, that was a joke. That was a joke.
The dark web.
Yeah. No, there's information out there a little bit. There's some YouTube videos. We're touching on it now. Jessie's talked about it a lot with her clients, so have I.
Mm-hmm.
All right. You mentioned that word before. Debt recycling. Talk me through it.
Yes.
What is it?
So, debt recycling is essentially, what I do is I invest in shares in any respect. And because I'm investing in shares, usually most people, I guess, just take money from their savings account.
Yep, like
whatever,
a transaction.
Like, $100, maybe they put it through ComSec or NAB Trade, or
Righto, yep.
people have like Raise accounts.
Yep,
the
yep.
nice
Plenty
app.
of our clients have them, yep.
Yeah, so just investing in shares. The only thing I think do differently to make my home loan tax deductible is I shuffle money that might be sitting in like my offset account in my home loan. Some people have offset accounts. Otherwise, most people or all people will have like a redraw or a home loan account. And if you shuffle money from your redraw account in your home loan, of the house that you live in, and say you bought $100 worth of shares through CommSec or NAB Trade, whatever it is, if you do it nicely with an accountant, the ATO will classify that as you're kind of borrowing from yourself for income producing purposes.
Yeah, to buy an income producing asset.
It's similar to like investment properties. So then that $100, you're essentially paying interest on an extra $100 because you've loaned it to yourself. So then the ATO will say that's tax deductible, the interest on that $100.
All right. So as a real quick sort of generalisation, you kind of two options two sort of main options, not the only options. Hey, I want to buy some shares. I've saved up a little bit of money. Most clients we find like grab it from my bank account, $100, CommSec, buy these shares, cool.
Yep.
Not really any tax deductions there, give or take. But what you're saying is now you can sort of, consider potentially shuffle that money into your home loan account as an extra repayment, which you can do. And then from your home loan, send it to your CommSec account and buy the shares. And that will turn that $100, you can then claim like the interest incurred on your home loan, I guess, from that $100.
Yeah, boy.
Right. So $100 over a perfect year, let's just say home loans at 6%, that'd be $6. So you're saying that $6 is then tax deductible. Right.
Which isn't a huge amount, but if you're doing like $100 a month or $100 a week, then it adds up and kind of accumulates. So then you've got $5,000.
Everyone's sort of different on their investment amounts, aren't they? Some people are pretty focused on it. Some religiously do 100 a week, 1,000 a week. So I guess that then magnifies if they're kind of doing an extra kind of money shuffle into their home loan account and then into their trading or managed fund or whatever they have. It's creating a paper trail to be tax deductible.
And you're literally doing the same thing. You're just moving it differently, and
you're still buying the same amount of shares, same amount of equities or whatever. But you're on the side note creating some of your bad debt, which we talked about with your home loan, into good debt. Hot sauce. Where was this in year 3? No, I don't know. Pretty sure. I don't think they teach kids. Yeah. Okay. It's interesting note. All right. We'll deep dive a little bit more into it. Or should I shuffle off and do this right now? No, that's right. All right. So, a couple of things you mentioned that will help us, and we'll get into a little bit of the numbers and a bit of a case study in a second. Is it fair to say that a lot of banks it's quite challenging to send money directly from your loan offset account to another external account? Is that Yeah, so you might need to then sort of shuffle it into your home loan account, as you mentioned, or your redraw. And then you send it from your home loan account or your redraw to your trading platform. And do you keep evidence of that? I suppose you have to if you're going to. Cool. Okay.
I find it quite easy since I've it lets me automate it. So I have automation every week. Goes from my offset to the redraw, and then because I've got a managed fund, so it's really easy. Just sends it to that, so I don't have to do anything. It just automates itself. So that's pretty handy as well. But paper trail wise, I guess if you get a good accountant that knows about it, there's not much paperwork that you actually need to provide. It sounds a lot harder than it is, I think.
Right. Good accountant. Okay. How do you choose a good accountant? Is it how they talk, how they crunch numbers, what they dress, how much booze they drink?
What do you think?
I think I did an accountant voice a few months ago and I got ragged for it. I was like, hey, come in here and I'll do your tax. Good accountants are worth their weight in gold. like any profession, there are quite good ones and there are not so quite good ones.
Yes.
Cool, like anything.
But ask your handy financial advisor for a recommendation.
Like and subscribe, email and phone number just here. Anyway, look, financial advisors will be able to take you through sort of the maths of it, I guess, on how it outlines. We definitely outline it to some clients. Some clients really pick it up. Some need a bit more drawing or communication with it, but it's definitely something that's pretty much perfectly legal. Once it's set up, it's be quite efficient. If you're especially using it to buy income producing assets anyway, and you've got a home loan, it bears a bit more fruit.
Why not?
Yep, why not? Okay. So I guess, and from that you'll probably need to gain some information, or your accountant could help you work through it. Sort of what you're going to be looking for is the money you've taken from your home loan and bought into your equities or shares, and then calculate the risk, the interest incurred on that loan. Is that right?
Yep. So my accountant likes me to have a very clean redraw account or home loan account.
Yep.
Where it's just the money going into shares, so they can kind of clearly see.
Cool.
For the ATO purposes.
Yep.
And they just kind of ask for my transactions into that account and out of that account for the financial year, and then they just ask for the interest that you paid throughout the financial year. Then they go do their thing, plug it in a spreadsheet, and then they calculate your tax deduction for you.
Yep. That's pretty handy. That's what I guess accountants are for, to do your tax return. That's really handy. All right. So we've done all that. So how is it? I've done a bit of this extra stuff. I might have sourced a bit more info, whether it's on heaps of the educational platforms out there. I've got the accountant set up. I've done this. How is it going to help me?
Yeah, I guess you won't see it until you do your tax return.
Yep.
Because it's kind of like...
Is that what we're doing this for? Just a tax return, a tax bump?
Pretty much. Like if you donate to a charity, you give like a $500 to a charity throughout the year or something, you don't actually get the tax back on it or reduce your tax bill depending on your circumstances until you actually do your tax return.
Yep.
So it's kind of similar like that if you think of it just as like a gift or donation. You plug it in at the end of the financial year into your tax return. It either reduces your tax bill but maybe even get a bit of a refund.
So I guess for people that were going to or have been buying share market-y stuff, technical term, I might copyright that. If they're doing that anyway, this is just a refined method that turns then again your home loan into tax deductible. You're going to do it anyway. So set up a few clicks, a few numbers punched in, and you're then sort of creating a paper trail where it's tax deductible, some of the expenses. All right, valid point. All right. So run us through a bit of an example just so we can kind of try and visualize the numbers then.
Yeah. So I guess, for example, if you had like a $500,000 loan and you're paying maybe 6%, like your interest rate was 6%.
So $30,000 a year? Very rough,
Exactly, $30,000 a year you're paying on interest. Just for easy numbers, just to give an example, say this has kind of happened with a client where they've come in, maybe they have 100K in shares, and we've gone through no, actually, I take it back. Perhaps you have $100,000 sitting in your redraw account.
So you've saved spare money, surplus money.
You saved a lot. It's kind of just sitting in your redraw account. Perhaps like saving you interest, which is good. But if you decided to put 100K, just for easy numbers, I know it sounds like a scary number, but if you put 100K into shares, say you bought some shares for 100,000, then out of your $500,000 home loan, now $100,000 is kind of the portion that can be tax deductible on any interest paid, and then the other $400,000 is just normal.
Okay.
So now it's separated. So about 20% is good debt, 80% is bad debt.
Cool.
And interest on 100,000 is about $6,000 a year. So you're essentially paying an extra $6,000 to invest that money.
Yep. Well, yeah, the bank's going to charge you that, give or take. Yep,
exactly,
yep.
Yep. So if you just like on a normal tax bracket,
32%-ish, 30 plus 2, yep.
up to about $135,000 a year
Yep.
in income. Then, because it's tax deductible, you'll get about 32% back. So that's
about
just
19, 20.
a little under $2,000 that you either reduce your tax bill by, or if you're lucky, you might get it back as a refund.
All right.
Out of nothing, out of thin air.
Yeah.
Sorry,
okay.
I'm excited.
Okay. And is that, is that the only way you can sort of tap into that resource, or is there another way you could maybe, say you've got a bit of equity in your home? Is that another way you could maybe use that money from your home loan to buy other income-producing assets?
Yeah.
Okay.
Yeah. Well, in Townsville, like house prices have doubled.
Or even Queensland,
recently, Queensland.
Yep.
So if you have,
say you've built up a few $100,000 of equity, you've gone to the bank and gone, hey, I bought for 500, now my house is worth $1 million. I'd like to access some of that equity. Is that kind of the same thing? Let's just say you set up use $100,000 of equity. So you could set that up to buy those assets, and the same thing kind of happens. Yeah. Valid point.
Another example is her client come in, they looked at their shares, they got $100,000, I think it was inherited. And they're finding the returns aren't substantial. Maybe the fees are a bit high, so they decide to kind of sell the shares. And maybe they want to invest in something else, like a index fund or whatever it is. Something you could do is, sell the shares, they're $100,000, put them in your offset account, or you transfer them to the redraw account, buy more shares, and now straight away you've already got $100,000 of tax deductible debt just by shuffling the money around, which you're going to do anyway.
Valid point.
If that makes sense.
It does. Give us a holler if it doesn't. But at the end of the day, I guess generally speaking, for those out there that have interest or are doing share market investment stuff, and you've got a home loan, there is a method there you can turn that home loan, bad debt at the moment, into sort of better or good debt. If you're still going to buy those share market-y stuff, there are potentially some benefits in using money from your home loan account. Even if it's as simple as moving it from your savings fund into your home loan and then home loan to your trading or managed fund platform, you're creating a paper trail that then becomes tax deductible. You're going to do it anyway. This is just an extra loop that creates a little bit of a kickback from the ATO. Well. All right. Okay. Valid point.
So what do you reckon, Yannick? Are you going to start now?
Well, to be honest, I've already started, yes. But it's, I guess, moving forward for a lot of clients, I do raise that if it might sort of potentially help them. Very general advice, horses for courses, but it's definitely something that's relevant for a lot of people that are in the share market and have a home loan and might have money in the redraw, some equity to use if they want, story for another time, or they're already consistently buying shares but taking money from their savings or transaction account. That's
Do you have any examples of clients where it might be applicable? Because I know you have a lot of defence clients that may get like a lump sum of compensation.
There is a few, and whether it's defence or even people that come across lump sums from compensation, inheritance, cash, windfalls, selling crypto, I don't know, whatever. I'm going to use that, like you mentioned before, I'm going to use that $100,000 or that big amount to buy shares. Awesome. If that's what you sort of want to do, go at it. But the two methods we talked about, one is then creating you're going to do it anyway. If your heart's set on it, you're going to buy those shares. One method, your method you outlined, the debt recycling, you're going to create a tax deductible paper trail, whereas if you've got the money in your transaction or savings account, you transfer it to your trading platform and buy them, there's not really any paper trail there to create it. So it is relevant for a lot of clients that come across sort of lump sums or financial compensation, if that's sort of the thing.
Yeah.
Bonus from work, that kind of stuff.
True.
Sweet, I got 20 grand bonus from work. I'm going to go put more money into managed funds, buy whatever shares.
Yeah.
Just consider how you buy them now and where it comes from and how it might sweeten the deal from yourself regarding the ATO. Okay. All right, J-Mac.
Yay.
That was actually pretty insightful, pretty handy. Anything else you want to add?
No.
Cool. If you listen to this and you'd like a bit of visualization or whatever, I'm not good at drawing the pictures, but Jessie is, so definitely feel free to give us a call, shoot us an email, and we can kind of go from there. There's a bit of YouTube stuff out there. You just got to find it. Legal, can do it, can benefit a lot of people.
Yep. For sure.
All right, folks.
Thanks, guys.
See you in a bit.
See ya.
All right.